I'm here at TradeTech with Doug Cote.
Investors need to accept normal volatility to build wealth. What we call the risk gap. Investors don't have enough risky assets.
So much for joining us, Doug. They're sort of throwing the baby out with the bathwater in Europe.
I think you're going to have to brace for some volatility.
U.S. Chief Market Strategist at ING Investment Management, who just gave a compelling presentation on what lies ahead in the market. Thank you so much for being with us today.
My pleasure. Thanks for having me.
Okay, to start us off, Doug, could you explain to the TradeTech audience some of the challenges facing the marketplace in the year ahead?
Well, there's a few things. I think it's a good economy in challenged markets. What I mean by that is what the Federal Reserve is doing to help the consumer to bolster housing is actually good. I agree with it. On the other side, what I see is some signs of slowing growth. In particular, a signal that I use. Corporate earnings. U.S. corporate earnings went negative in the third quarter. That's the canary in the coal mine. That means that if U.S. corporations can't quite get it done on a year-over-year basis, something's wrong. I think that problem emanates from Europe.
Speaking of Europe, in the headlines this week, they were talking about the stalemate in the Italian election. It obviously shows that there's still a lot of fear with Europe. Why do you think that they can't get their act together? Why do you think Europe is still in a decline right now?
Well, we started off with the Euro debt crisis.
Sure.
We almost call it the perennial Euro debt crisis because it seemed every 6 months there was a new one. And what I thought over the past year and a half, 2 years, is they have to solve this debt crisis problem. And I thought they had an effective fence around the debt problem. And then we saw the ECB come in strong, and with the LTRO, we saw effective policies. They're talking about a fiscal union, and they're talking about a banking union.
Sure.
Now, 2 years later, I've seen very little progress on the growth side of the equation. And what I mean by that is Europe in 2012 was in recession. Now, the IMF came out and said Europe will be in a recession for a second consecutive year. If they don't start growing, all the debt forgiveness in the world won't matter. They have to grow their economy. They're not putting the policies in place. And with the Italian election, is they need to elect prime ministers and candidates that will start to grow their economies, structurally reform their labor markets to make them more open, to make them more exposed to the global economy. I don't see any progress on that.
But then there's also been sustained growth in China and the U.S. avoiding the fiscal cliff. There seems to be a great deal of momentum overall in the market right now. Do you think that it will last? What are the risks that traders should consider moving forward?
Well, I think certainly the financial sector has been cured because they've been supported by the U.S. Federal Reserve. Their reserves, they've had a lot of tests, a lot of stress tests. U.S. banks are probably in the best shape they've been in 5 years or even longer. And we have some standards that are being put in place so they can't take the risk. They can't do this too big to fail anymore. So, but if you look to Europe, they're definitely in a better position that they've been in. Mm-hmm. But again, if their banking system is exposed to their economies if they don't continue to grow. But I would say overall the financial sector is in reasonably good shape. But markets don't pay for level and for share. They pay for growth from here. And that's when I'm seeing a challenge. I also see on the plus side, what I talked about in my presentation is tectonic shifts in energy, global trade, frontier markets, and technology. This is non-market trends that are in the real economy that could bolster or surprise on the upside, catalysts for growth, the market. So I don't think, certainly I'm not Armageddon. I'm saying I'm defensive, still in the market, but I'm waiting for the market to show me the money, show me corporate earnings.
Sure. And you said in your presentation that energy is the game changer out of all four. So why is it the game changer?
It's already changed the game. We are going to be energy independent by the end of this decade at least. I think it's going to be sooner because of fracking and new trends and bringing natural gas out. We're on track to be one of the biggest producers of energy in the world, not only in natural gas, but in coal. We're the Saudi Arabia of coal, we're the Saudi Arabia of natural gas. We have so this will sustain us. If you look in the Midwest, because of this fracking energy revolution, North Dakota has full employment, all the Midwest, full employment, and this can only help our economy. The biggest way is if we start to export, because the trade deficit that we've had since 1975, because of reducing imports, expanding exports in energy, we could go to a trade surplus. I'm forecasting that within the next 2 to 3 years.
You mentioned energy, obviously, and the Panama Canal expansion as two key trends to capitalize on. What strategies are you employing to actually capitalize on that?
Broad global diversification. One of the key things, and I pointed out in the presentation, I showed a model portfolio, is that the SP 500, as good a year as it had last year, was second to last of the equity indices I follow. The emerging markets, the EFA, mid cap, small cap, broad global diversification really matters. As a matter of fact, I take that not just equities, but in bonds, global bonds, high yield bonds. This is where the action is. So you can build a diversified portfolio that has low risk and builds wealth. And my target is between 8 to 10% return. But you have all these investors. There's $7 trillion of cash on the sidelines and earning zero when they could be making near double digits. And you do that by effective diversification.
Okay, and then in a CNN Money article that recently came out, you were quoted saying that it's time for investors to get defensive. Can you expand a little bit on that?
It's driven by what my investment philosophy is, that fundamentals drive earnings. Fundamentals drive markets. Corporate earnings are the signal that I use. And what you see is over the past 3 years, 12 quarters, earnings have been growing. So I've been bullish on the market through this volatility. In the third quarter 2012, it went negative. So what I say is something's wrong. Something is rotten in Denmark. Houston, we have a problem. So I back off. I trim equities, reallocate it to bonds, and then I wait until the first quarter, next quarter, of positive earnings. Now, that could be 1, 2, 3 quarters or more, but I wait until I see the sign that things are back to normal.
Sure. In your presentation, you were also talking about looking to emerging markets for future growth. What do you think are some of the benefits and some of the disadvantages of looking to an emerging market as a strategy?
Well, emerging markets is where all the action is. If you look at the consumer growth in China, they're growing at, let's say, 7 or 8%. In Brazil, they're growing at double the United States. In Chile and Peru, we actually came up with our own acronym that we call PIVOT. It's Peru, Indonesia, Vietnam, Oman in the Middle East, and Turkey. You look at those economies, they're going gangbusters. That's where the action is. That's where U.S. corporations are going for top-line sales growth. You look at the top-line sales growth, half of these bigger companies, their revenue is in these emerging markets.
Talking about the energy tectonic shift, you talked about the power gap. I was just wondering, what impact will the U.S.'s power gap have on the market, do you think?
Well, it's interesting. I wrote that article before Sandy hit the East Coast.
Sure, okay.
And what it showed is that power is, to the United States and probably to the world, it's like air and water. It's an essential. So if you have something that is essential, then you should have backup and recovery, and we just didn't have it. And I was saying it was a risk that, and I got that because Connecticut had a big storm the year before we were out of power for 11 days. And you know what? It felt like Armageddon. And I'm thinking to myself, why don't we have backup on natural gas? Why isn't everybody hooked up to that? Why don't we have backups for transportation? There was actually, we could have allowed international freighters to come up to the East Coast, but there's regulations against that. Why? So there's a lot, and then when Sandy hit, is they were out for well more than 11 days. I can't imagine how those families reacted. So as the United States government, we should rebuild with the idea that this can happen again, and to have secondary sources. So my big thing is, everyone's talking about the natural gas craze, but half our power is still coal. It's an important source, and what I'm concerned is the environmentalists are dismantling one of the most important, what I would call maybe in the future, a secondary backup. But what if we got rid of coal and we just had natural gas and something happened to natural gas? We'd be begging for this coal. Nuclear power as well. We should be all in because of this is basic backup disaster recovery principles, and the U.S. government is not protecting the population adequately on the power gap.
Of course. Well, Doug, thank you so much for being here at TradeTech and for sitting down and talking with me.
My pleasure. Thank you.
Thank
Thank you.